My name is Avneeta, and I'm a junior in high school who's interested in business but focusing more on the more marketing and strategy side of business. So, Tia and I started Clear Business Boost because we realized how many small business owners feel overwhelmed by constant changes that are happening, especially with finances, operations, technology. There's so much information out there, but not enough spaces where everything is explained in like a simple, clear, and straightforward way. So that's where our nonprofit comes in. We want to give business owners access to experts who understand the challenges you guys face every single day and who can break things down in a way that's practical and actionable. And before we get started today, before we get started with today's session, we'd like to tell you guys about one of our next events that are coming up in January called Marketing That Moves Your Business Forward. And that's going to be led by Heidi. And she'll discuss how to attract the right customers with a modern marketing engine built around how buyers actually make decisions today. So, today's session is all about something that every business deals with, but almost no one talks about openly, which is cash flow. It's one of those areas where many business owners rely on instinct rather than data, and that can cause a lot of unnecessary stress. So we're really excited about today's speaker because he brings decades of experience in helping small businesses understand their numbers and make stronger financial decisions. And with that, I'm going to hand it back to Tia to introduce him.
So, we're incredibly excited to introduce Joel Smith, the founder of Clear Action Business Advisors. Joel has over 27 years of experience in finance, cash flow management, and strategic planning for small to medium-sized businesses. He holds his BS in accounting and finance from UC Berkeley, his master's in taxation from Golden Gate University, and he's both a CPA and a CMA. He's worked across several industries from construction to real estate and he's helping business owners turn confusing financial data into clear and confident decision making. But what really stands out about Joel is how approachable he makes complex concepts. He's coached business owners who are on the brink of giving up, helped companies find hidden profit leaks, and even taught leaders how to read the story their numbers are telling them. So we're really honored to have him here with us today. And as he goes through his presentation, feel free to jot down your questions. We're going to have a quick Q&A right after, or feel free to type them in the chat in real time. Joel, the floor is all yours.
Okay, great. Let me see. Can I share my screen here? And can everyone see that? Can you all see my screen?
No, well, now you can. Yes.
Okay, got it. Okay. Well, thank you for having me here. As said, probably reiterate some of the things said in the introduction, but I am Joel Smith and I am the founder of Clear Action Business Advisors. I founded this company. I mean, I've been a CPA for many years. Started out in tax practice or working in just public accounting generally, and many years ago. But I founded this CFO service, this practice, because I found really large needs among small business owners to have more guidance in their financial aspect. If you look at any major company in the world, they have a chief financial officer on board. However, smaller companies simply can't afford to have this because a CFO, no kidding, is going to cost you minimum $250,000 a year when you throw in all the payroll and benefits and all that stuff. And so, the smaller companies can't afford that, but they need this help every bit as much, if not more so. So recognizing that, I decided to focus my attention on those types of services. So tonight I'm going to fill you in a little bit of my background and my story and how I came to offering CFO services. And then I'm going to kind of give you a presentation that I call Build It to Sell It, whether or not you intend to. I believe, and I'll get into this more, but I believe businesses should be built with the exit strategy in mind, but most importantly, I think they should be built in such a way that people as if they're going to sell it, even if that's not their intention. I'll explain that more. So first, let's go a little bit about my background. This was already explained. Yes, I graduated from UC Berkeley in '93 with a degree in accounting and finance. And after graduating, I went to work for Bechtel Corporation in their controllers organization for 3 years. And while working there, I obtained my certified management accountant credential, otherwise known as a CMA. But of course, I wanted to get that CPA. So I eventually left Bechtel to go take a job in public accounting, expecting to only work there a few years, get my CPA, blow out of there, and work my way up the corporate ladder of GM or something. Anyway, things kind of changed. I ended up going into public accounting and I liked it more. And so I've been pretty much in public accounting ever since. I got my CPA credential in 2002. And I've been working with a small business, local CPA firm, pretty much most of my career until I finally went out on my own in late 2012 and started building my own practice. I was taking my master's course in taxation from Golden Gate University at that time, and I finished that up 2014. Um, let's see. So I think one of the things, having gone out on my own, I built my own practice from the ground up. I think most CPAs who eventually become partners in firms, they buy into a practice. And for me, since I built it from the ground up, I know what it's like to be a small business owner and have to build it from the ground up. And so I've experienced the stresses and the challenges. It's particularly in the accounting industry. A lot of accountants are retiring, not enough young accountants coming up through the ranks. So it's a very expensive industry to hire in. And as a small business owner, I found it very hard to compete with larger outfits as far as compensation packages. So I've had to learn to work around and make things work. And so I bring that experience along with just the accounting knowledge and background. So kind of my story, as I said, I went out on my own in 2012. And since I've been working the entirety of my public accounting career with local CPA firms, my whole professional life has been focused on catering to smaller, closely held businesses. And over 8 years, I built up a practice of about 300 clients. Um, but along the way, I came across a client that I considered to be my ideal client. And I had decided that I wanted to build a practice around catering to this specific type of client. And what was different about this client is we didn't just do a tax return. We actually took over the entire accounting. We were doing weekly accounting for them and as well as all their tax returns, payroll, anything they needed. We were complete accounting. And this was to this day still my highest paying client I ever had. And yet I had cut their tax and accounting costs in half. It was such a win-win situation. It just made total sense for me to try to build around this. And I thought it would be easy. However, it wasn't. It was very difficult. And I finally had to come to realize is a lot of smaller businesses, it's very hard to find them who were willing to hire an accountant to keep them up to date on their accounting regularly. A lot of small business owners, they just don't pay attention to their accounting. Um, I finally come to realize the reason why is they don't know how. Most small business owners are very good at what they do when they build their business. They've learned to do that and they build their business around that basic idea. And accounting was something they never really learned. And so they don't pay attention to it because they don't know what it means. And so I believe that's one of the biggest mistakes small business owners make, though, because if you don't learn to start running your business by the numbers, you'll never truly build a business. What you build is a self-administered job. So with that in mind, um, you know, um, I created the CFO service. And so I'm there to be their guide. Again, I've come across clients have told me many, many times they don't understand numbers, they don't get numbers, they're happy to have their bookkeepers, and that's all fine and dandy. But when you get right down to it, business is about numbers. They've got to make sense or the business will not work. So along the way, I came across this group called the CFO Project. And what they did is they created a scalable CFO service that was specifically designed for these small businesses. So I didn't have to convince business owners anymore to start paying attention to their accounting that they didn't understand. I now was able to offer them a service where I would be their guide. Just like any large corporation, they could have their own CFO to help them interpret this data. So quickly, I'm going to go over that. There's basically three functions of a CFO, and then that is to track the profits and cash flow of a company, analyze the company's financial strengths and weaknesses, and propose corrective actions when necessary. So with that in mind, I want to kind of go over my basic presentation, which I call Build It to Sell It. I'm going to come back to those three functions in a little bit throughout this, but the reason I present this topic is I've been talking to a lot of business brokers lately, and I've come to realize that a lot of the things I'm trying to help my clients achieve through my CFO service have a lot of overlap with what business brokers recommend be done in order to maximize the value and sellability of a business. And I have come to believe that every business should be built with such an intention in mind. And there's really five reasons for this. Reason number one, it's a plan. It's amazing how many small businesses really have no plan at all. They just operate day to day with no concept of where they really want to get to. And it's pretty hard to be successful when you have not defined what that means. So if you put a plan in place to have your business ready to sell for a specific price by a specific date, that will go a long way towards helping you focus your efforts towards a direction. And what I mean by that, I mean literally saying, like, I want to be able to sell my business for $10 million by the year 2030. Now, once you do that, okay, now you've got a plan and you're going to have to start doing certain things to achieve that. And that's my next reason is that businesses that are built to sell will be more profitable. One of the key factors in making a business sellable is profitability. And by setting a desired price, it will set you on a course for attaining a certain level of profit that justifies that price. Reason three, a business that is built to sell will be less time consuming. One of the most important value enhancing elements of a business is building it so that the owner is not essential to the daily operations of the business. So it is in every business owner's interest that their business be built to operate without them, which will in turn necessitate less of the owner's time. Then reason number four, a business that is built to be sold is less stressful, at least to the owner. So by taking the time to build out the systems, the business will, one, it's going to run smoother. There'll still always be problems, but there will also be somebody who's assigned to be responsible for dealing with those issues and thus alleviating the owner from having everything fall on his or her head. And finally, the big reason for building it to be prepared for sale is that life happens. And then over the last decade or so, I've seen it several times where a business owner had to sell their business in a hurry because either cancer's been the big issue. Either the owner or the owner's spouse has come down with cancer. And so now they had to focus all their efforts with dealing with that. So they had to sell their business. And if it wasn't prepared to be sold, it wasn't the most ideal circumstances to sell it. In fact, I've even seen some business owners literally have to shut their business down and walk away, which is kind of sad when you think of all the years they put into building it and they just have to shut it down and walk away with nothing. But the problem is they just weren't prepared for the unexpected. So that's why businesses should be built to be sold. Now, from there, they could do all kinds of things. They could, give it to their children or whatever, sell it to their employees. But by building it to be ready for sale, it's going to be a smoother, better operating business. So what makes a business sellable? Well, the business brokers I've been talking to have pointed out, let's see here. I got one, I've got a extra line in there. So overlook that number 4. But anyway, so the basic, what makes the business brokers I talk to tell me is the characteristics they look for when selling a business, when advising a client on buying a business is, 1, having realistic expectations about the business. There's often a disconnect between what the owner thinks a business will sell for because and what it actually will, because they haven't really put a lot of time in preparing it for sale, and yet they expect the fetch top dollar. 2, the business should have books that are clean and well organized. So brokers' assessments of value will be ascertained by viewing the accounting records, and any potential buyer will want to do the same. And if the accounting records are a mess, they're not tying to the tax returns, or there's something about them that just doesn't look right, savvy buyers will walk away. There's no point in trying to buy a business based on information that may be inaccurate or, incomplete. 3, a business should have income statements that show a profit. And I mean, I work with a lot of small business owners. They often get maniacal about avoiding taxes, and they go to great lengths to never show a profit, sometimes commingling their personal expenses or just going out and spending all the money down so that the business has no profit and therefore they don't pay any taxes. And this is a bad business strategy on multiple levels. Number 1, the goal of any business should be to maximize profits. It might cost some in taxes, but it'll also help maximize the wealth the business provides the owner with. And don't get me wrong, I'm all for a prudent tax strategy that minimizes taxes within reason, but not if it means spending everything you make just to avoid paying taxes. Because in this instance, what you're doing is you're spending $1 to save maybe 40 cents. And that's just not good economic strategy. And the other issues with this is it often makes it hard to obtain financing if you need it. And of course, if the business ever needs to be sold for some reason, it makes it less valuable. And then finally, the most important and the most overlooked feature that most greatly enhances a business value is proper management infrastructure. That means building systems that allow for the business to run without a lot of owner involvement, what is often referred to as turnkey. If a business requires the owner to be there to make it run, any potential buyer would have to figure out how to move into it and replace that owner, and essentially replacing the current owner's sweat equity for their own. Such a business will have a heavy discount to cover for the fact that the purchaser will either have to work in the business or hire somebody to do it for him. So the more systems that are in place to make the business more self-sustaining, the more valuable the business is. And that leads me to my next concept, which is I call building a machine, not a job. Um, and basically, a business should be thought of as a machine, a money-making machine. I like to use an example of a washing machine. Now, its purpose is to wash clothes. It's made up of many multiple parts. It's got the drum, the water dispenser, soap dispenser, timer. All these parts work together towards one common goal, which is to wash clothes. If it fails to wash the clothes, there's a reason why something's not working. If you find that reason why and fix it, then the machine will get back to doing what it's supposed to do and give you clean clothes. So, in the same way, a business is also a machine, but its purpose is to make money. It's made up also of multiple parts, which was talked to. You're going to have the accounting systems, administrative systems, IT systems, marketing systems, and of course, the system for producing the products or delivering the services that this business does. And they're supposed to all work together towards that joint purpose. If it's not making money or enough, there's a reason why. And you got to get in there and analyze the parts of it and figure out which parts are not working and fix them and get the machine back to doing what it's supposed to do, which is make money. So, and money cures a lot of things in business. In fact, almost everything. By making more money, it allows the business to hire more or better people, do more or better marketing, improve the quality of the products or services, hire experts that can help grow the business, hire better management, expand locations, buy equipment, vehicles, supplies, and inventory, pay down debt, even take time off because you can afford to pay someone to take your place, and most importantly, pay the business owner something. One of the problems is most business owners don't really build a machine. They build themselves a self-administered job. And this self-administered job tends to be very stressful and high demanding. It does not provide a steady paycheck. It does not guarantee time off for weekends or holidays, and certainly not paid time off. And that's the problem is most business owners start or buy a business with dreams of wanting more control of their time or how much money they make, or both. And ironically, because most businesses struggle to do what the business is supposed to do, which is make enough money, the owner ends up losing that control they wanted in the first place. They end up having to work more in the business because they can't afford not to, and they end up working for a lower effective rate as they put in more time for the same or less compensation. So, in fact, SBA studies show that 86% of business owners make less than $100,000 a year. And when you consider the risk and the time spent for what is made, often it's not worth it. It's better just get a job. So the big question is why are most businesses run like this? I think it has to do with our education system and how we're trained, how we're brought up. If you look at the education system in America, it is designed to teach us how to be an employee and get a job. No one ever really teaches us how to build the machinery needed for a smooth running business. And after we finished school, most of us went on and got a job. So we're trained to do a job. We end up doing the job. That is what we know. And so for people who do at some point decide to go into business for themselves, they tend to run it like it's a job because that's what they've been known to do. So, example, the HVAC guy is obviously going to start an HVAC business and he runs it like the job he used to have for somebody. And the dentist will start the dental practice, but there's all the other parts, the marketing, the admin, the accounting, da, da, da. And they often do not know these things. And so those other parts of the machine suffer. So what's the solution to this? And the obvious answer is they need to turn their self-administered job into a machine. And they need to understand it as a system that is made up of subsystems that operate together to fulfill its purpose of making money. And the key to evaluating this machine and all of its parts is the accounting system. And this is not easy for most business owners. As I mentioned, they're not necessarily numbers people. And money and cash flow and the different parts of a business all come down to numbers. Most business owners understand they need to know their numbers, but they're not exactly excited about poring over data to understand their parts and determine which ones need improving. And that's where the CFO comes in. So I want to go over what I call the parts of the machine. And I call these drivers. And there's basically 5 drivers of revenue, 5 drivers of net profit, and 5 drivers of cash flow. So the 5 drivers of revenue include the number of leads, the conversion rate, retention rate, purchase frequency, and average purchase value. These all add up to gross revenue of a business, which becomes part of the next set of drivers, the profit drivers, which is that revenue, cost of sales, payroll expenses, marketing expenses, and overhead all combined to provide the company's profit, which becomes part of the cash flow drivers. And this is where a lot of people get confused because most people basically understand the profit and loss statement. They don't understand the balance sheet, which is where the cash flow drivers are. So once you've got profit, you've got to account for changes in accounts receivable, changes in inventory, the purchase or sale of assets, changes in debt, and the owner's investment and draws. So for my clients, what I usually do is I like to sit down with them and establish a cash flow goal. How much money do they want to see in their pocket from their business, plus what stays in the business? And then you work through the cash flow drivers and say, this is the profit you're going to need to deliver that cash flow. You work through the profit drivers and say, this is the total gross revenue you're going to need to deliver that profit. And then you can break it down into those revenue drivers. How many leads will you need? What kind of conversion rate? Should you work on recurring sales? Yada, yada. All these things to deliver that revenue. And with that, I'm going back to the three functions of the CFO: tracking profit and cash flow, analyzing the company's financial strengths and weaknesses, and proposing corrective actions. This provides the basis for my 6-step process to having a growing and more profitable business. Function 1, tracking the profit and cash flow, consists of steps 1 and 2. Step 1, I sit down with my clients at the beginning of the year and establish targets on all those 15 drivers I just went through with you. And then from there, we'll set the goals and break it down to monthly amounts. And then on a monthly basis, I get updated actual accounting data. So I can then compare that, which leads me to the next function, analyzing the financial strengths and weaknesses. With the actual information I have, I create a forecast of where it looks like the business is going, and I compare it to the various targets on all the drivers, and I give a score. And I'll show you the scorecard in just a second, give you an idea. But what we do then is by comparing it, we know where they're on track and where they're not. And from that, the areas where they're not on track or they're off track, that's where we discuss. That's the next function, proposing corrective actions. We'll discuss the reasons why they're not on track, come up with some objectives, and then specific next steps to take to bring the company back in line with their stated targets. And from there, this is basically the scorecard I told you about. These are the 15 drivers. And this is just an example, but I'll go through and look at all their numbers and I'll give them so they've got a visual representation of what areas are working and what ones need attention. And from that, we come up with our action plan. The areas that are in the red will create objectives. In this case, I said make the sales are low. So maybe making an objective of wanting to increase sales by 10%. Well, what can we do? We'll create specific action plans, steps, assign it to somebody responsible for implementing it, and a due date. And by doing this, I help my clients not just set goals and targets, but measure their progress and take the corrective steps that are needed as they go about doing their business. So that's basically what I do as a CFO. Anyway, so I kind of put it out there that when I'm talking to potential clients, I start out with what I call a right fit call, where I discuss their goals and their challenges and have a discussion to kind of see if they're really ready to make changes, to see if they'd be a good fit for my program. And If they are, then what I do is I offer them a free financial assessment. They'll share their books with me. That way I can kind of show them what it is I do in real time, and they can make a decision whether or not it makes sense for them. Even if they decide not, they'll come away with a much better understanding of the financial strength of their company than they came into it with. Everyone I've done this for has basically told me no one's ever told me any of these things. So that's kind of what I do for my clients. And with that, I guess I can open it up to questions.
Yeah, thank you so much, Joel. You took a topic that feels intimidating for a lot of business owners and you made it feel really clear and manageable. I also really liked how you simplified like measuring progress. It makes everything feel a little bit less overwhelming and more like actionable, right? So before Tia and I like ask you some of our own questions. We'd love to hear from the audience first. So if you have a question, you can drop it in the chat or you can just feel free to unmute and like jump in.
I
Joel,
have a
great.
question.
Oh, go ahead. I'll go
Oh,
next.
sorry. Um, so you may have said it, I just may have missed it. When you work with the client, it's over like a year plan, a year, 2 years,
I
and then you meet every month and all of that. So how does that work?
The idea is we start with doing a full year plan.
Mm-hmm.
And we plan it out for the year. Eventually, if things go well, I will even go as far as to lay out a 5-year plan. So this program's designed to be an ongoing thing. The
Mm-hmm.
hope is they'll be stick with me up until the point where they decide we really do need to hire our own CFO, and we can afford the 250,000 plus it's going to cost. You know, And so yeah, so it's designed to be an ongoing engagement, but it's in that will thing. Ultimately, the goal should be is I should make them a lot more than I charge them.
Right.
And
The other piece is, who is your like target client? I mean, what are the types of clients that you're mostly
I've been
serving?
targeting a lot of tradespeople because they hit the two things that I look for that this is a lot of people in the trades. They're good at what they do, right? The plumber
Mhm.
knows his plumbing, or the electrician knows his like how to do all his wiring and stuff, but they often don't have the financial knowledge. So that's one. Also, tradespeople often have cash flow problems. They finish up a project, they got to start the next one. They haven't been paid for the last, and if they're doing multiple, that just compounds. But
Mhm.
basically, I work with businesses who are having issues in growing. Cash flow issues is often a big problem. So businesses that carry inventory,
Mhm.
because you got to invest money in inventory, you don't have that cash until you sell it. So you got to plan that out. But yeah, basically any kind of business owner who's just thinking something's not working and I don't know why. I
Right.
promise you, it's in the numbers. And
Right.
that's another reason I like to give them that free financial assessment. Is I just go through and we go look back the last 3 years and through the trends, and I can just show them this is where you're bleeding.
Okay. Perfect. Thank you, Joel.
Sure.
Yeah, Joel, great presentation and summary. Similar in terms of what companies, so that helps on the trades. Is there a certain dollar amount or number of employees that you
I
hit?
generally say 500,000 and above.
Okay.
I'm willing to talk to people below that, but they should be moving towards that 500,000. When I first started, I used to say 500,000 to 5 million.
Mhm.
Thinking at 5 million they could afford a CFO. I
Yeah.
enough the clients I've worked with tend to be between 5 and 15 million. Um, so
Okay.
I'm kind of targeting saying million to 15 million, and so somewhere just five hundred
Yeah,
thousand
that makes
above.
sense. And then question for you in terms of the tech stack, are there certain programs then that you recommend, like, for those companies getting started, like QuickBooks, or is it,
I
or you're
QuickBooks is
agnostic?
one of them. You generally need some type of accounting program. So QuickBooks generally does pretty well for most people. There's other ones, there's Zero. If you think you're gonna have a really complicated accounting package, God, it used to be Peachtree. What did that turn into?
And by the way, it's less for me. It's a potential client that I may be working with that, we can talk offline, but, it's really just getting started with their system, but they've got a thriving business. So, yeah.
Okay. Yeah, no, I'd love to chat with them and but yeah, I'm assuming that they'll probably have some kind of accounting package like either Zero or
They
QuickBooks.
need something. Yeah, exactly. So,
Okay, they don't have some. Okay.
oh, there's a
Yes,
lot of
they
businesses, right, operating off spreadsheets and manual.
oh
So,
it's crazy.
yeah.
I mean, again, and maybe in the early days they can do it, kind of go by intuition. As the business grows, that's going to become harder. The problem is by not implementing the systems at the beginning and trying to go implement them
Oh,
later,
yeah.
it becomes harder.
Yeah, and even just the bookkeeping, right? Like
Yeah,
categorizing the expenses, that can
yeah,
be a nightmare. So, yeah.
yeah, it can be. So if you get into a habit of having somebody do the accounting regularly each month, one, you look back at a transaction that's fresh in your mind. But more importantly, by doing that, then the owner can look at their financials regularly
Yeah,
and get a feel for it,
exactly.
and see what's going on. And that's
Then
something.
I love what you said too. I'm part of an exit advisor alliance. I love what you said about, just thinking about it for the sale and not for the
Yeah,
taxes, because you see this all the time where everyone's trying to get the taxes low and but then they're shooting themselves in the foot. And it was such a good example because like Black Friday and everybody's so excited about like, oh, 40% off, but
yeah,
really if you buy something you didn't need, you could have saved 100%. So it's
right.
similar to what you said. So anyhow, thank
I,
you.
I've seen this. CPAs will tell their clients, "Go buy yourself an SUV." But if you don't need the SUV,
Right.
you're throwing away what, 60 grand, and you might save somewhere around 25, 30. It, it,
Yeah.
it's really getting that anti-tax doesn't make sense. You're better
And then
off
if
paying.
they go for the loan later, then
Yeah,
all of a sudden the numbers are lower. So
right. I like to tell them, if you really want the tax deduction that much, let me bill you 60 grand. I'll pay the taxes on
yeah,
it.
there you go. That's a good
So
answer.
So, Joel, some very good points. And one question that came to my mind, and obviously this is for my selfish reason also, like some of my clients, when I'm running payroll, I want them to be very successful so that
yeah,
they can continue to run payroll and grow. But one of the things that I feel at times that they're reluctant to hire a CFO is thinking that this will be expensive. This will be a cost.
yeah,
And you made a very good point that you want to charge them less than what they can have that delta. They'll make more. So essentially, whatever
and
more they will make, your fees will actually be paid out of the increment that you will help
right,
with. So
right.
it's a
And so
no-brainer
then
from
it's
that point of view. But
right,
how do we convince someone that, okay, hey, you need to start spending and hire someone like Joel
yeah.
so that you can make more
You,
money?
you got to change the wording around it. It's not expensing, it's investing.
Yeah.
So
No,
you put,
I get it. I am
yeah,
with you. I'm 100% with you. But I'm thinking,
yeah.
how do they change their
So
mindset?
again, like that CFO hiring them for 250,000, if they make you 300,000, it makes sense, right? Because yeah, you're spending, but you're making an additional 50,000. So if this person, this is what everyone's got to buy something in their business,
Yeah,
and they do it to produce it. They're investing in something to produce an income. And so the idea behind it is if they don't have a plan of where they're going to the business, they're probably not operating efficiently. So what I help them do is operate more efficiently and with a plan in mind, which will make their income higher after netting out me as a cost.
yeah,
So it's an investment.
makes sense. Good. Thank you.
Mr. Joel, thank you so much for sharing your insights here. I have a question more from a startup point of view. I see. I think that maybe for the startups and for maybe the non-tech startup companies, maybe the finances are looked at differently. I'm wondering because a venture-funded company, he's incentivized to spend money, not so much generate free cash flow in the beginning, right? They'll invest. They'll in fact borrow money
Right.
get
I mean,
money, right?
I remember that the dot-com explosion. I used to go to some of those tech companies. They were spending crazy on all kinds. Every employee room was just stocked with all this garbage and stuff. But I mean, a startup, you got money coming in, and sometimes they'll think, hey, we don't have to worry about it. But they do, because at some point, these people who put funding into a company want to see a return on their investment.
Yeah.
And and it can't go on forever. At some point, there's got to be a plan in place to make a return. And
Absolutely.
so just spending money like nuts, I don't think spending money prudently is what's going to make that become a reality.
Yeah, so do you advise companies, startups under $5 million or so as a CFO?
I guess I could. The reason I usually say 500,000 because it's an ongoing monthly engagement. Like a CPA you go to, maybe pay him 1,000, 2,000 do a return once a year, where this is an ongoing. So they would need a source for paying that, which is, obviously. But yeah, I'm happy to talk with them. At very least, I do offer something I call my outsourced tax and accounting department, whereas that's where we do regular accounting and tax work for a flat fee. And at very least, I think they need that even in the startup phase because they still need to do their accounting.
Got it. Yeah. So if there is a brochure or a flyer or something that you have, I know a lot of people who are in startup who have startups in early stage are there in that 500K to 5 million, right? So I
Yeah,
can share it with them.
I will. I've got one in the making. I don't quite have it in hand, but I should
Okay.
have it pretty soon. So
Okay.
yeah, if you give me your contact, I can make sure to get it out to you.
Sure. Yeah. I'll send it.
Okay.
I see Edna has a hand up. Do you have a question?
Okay. Hello, Edna.
Um, the question, I forgot the question between the I should have written it down. It'll get back to me. So
Okay.
sorry about that.
Yeah, I just had one more. From the different businesses that you've seen, let's say, over the last 2 to 3 years, are there any categories where you think the expenses are just, you mentioned the one about like crazy spending just to avoid taxes. Are there other categories, let's say, that are just common pitfalls that you see small businesses
Well,
spending?
sometimes people just go easy routes and they don't necessarily look at things. I'll give you not necessarily a business I'm serving. The treasurer of this nonprofit, and we got in there and we just seen that certain things are happening. It's like, oh, we could just drop this expense by going this, not taking the time to analyze it. Is there a cheaper, easier, better way?
Okay,
Um,
going for something quick.
yeah,
Yeah.
sometimes it makes sense to kind of go through, and that's what accounting records should do for you, is you should be able to
Hmm.
look at it and say, this is what we're doing. Is this the most efficient way to do it?
Yeah.
Anyone else?
Yeah, then I can go ahead and ask a question. So,
Okay.
what's the biggest misconception you think entrepreneurs have when they try to fix their finances?
There's misconception. Cutting expenses, right? And when people are struggling, the first thing they do is cut expenses. That might not be prudent. I mean, again, going back to that question, yeah, sometimes you want to go look at it and see if there's but you also got to be, if you cut certain expenses, will that damage your product or service? So sometimes cutting expenses can hurt. So sometimes you do need to make more investment. And I think people can tend to get worried. And this is another reason why having kind of that projected set targets and stuff really help. People tend to get worried about laying a lot of money out if they're not sure they're going to get the return on it. Um, and so, but if you have a clear idea of, hey, this is what we need to make, then you can assess what is the likelihood of being able to do that. Is this a venture we want to try? Then it becomes more of a measured risk than a gamble.
I also had a question. It's a bit more reflective.
Yeah.
But yeah, I really liked your presentation. I also agree with Heidi. I thought the whole focusing on how to sell, how to build it to sell and not
Yeah.
to tax cut, that was really interesting. So my question was, if you could go back and give your younger self one piece of financial wisdom, what would that be?
Have a plan. Have a clear idea. Have your goal set. Start with the goal and then lay out the plan, lay out the steps. One thing you see these big multi-million dollar corporations, they were all small companies. They didn't become these big things by accident. Somebody planned out a set of operations that helped them grow.
Thank you. Did anyone else have a question or Edna?
If you remember your question sometime, then just shoot me an email.
Okay, if no one has any questions left, then we can go ahead and start closing. Or Edna, do you remember your question?
No, no, no. I wanted to thank Joel. It was really, really, I'm glad that I joined. It was very informative, and now I know a lot more than I knew before. So, um, you should do this again,
Yeah.
Joel.
Okay. The
Yeah.
7 minutes in BNI doesn't do it. I was
I
thinking
know it
about
doesn't.
BNI had this podcast and talking about an annual marketing plan, and one of them is having a monthly webinar. So that was going to be kind of my plan for 2026 to do something like that.
There you
That's
go.
awesome.
Yeah.
Good.
That's awesome. That would be awesome. Yep.
I feel the same. It was quite informative. Once you go a little bit into the detail, you start thinking at a wider scale rather than just, few pointers. Then you get more information. Okay, this is what you do. But going through this, it opens up a bit more in terms of how we should look accounting and finances.
Yeah, I also agree. It was pretty insightful to hear, even though it doesn't directly impact me today. It definitely will in the future, and some tips and tricks that you've shared will help me in other aspects of my life as well. And I think your approach to this whole thing just makes financial clarity feel achievable for any size business. And we're really grateful for the insights that you shared.
Yep.
Yeah, very informative. Thank you for putting this together. Thanks, Joel.
Sure. Yeah.
Yeah,
And
and thank you to the young ladies. Oh my gosh, I'm so
Yeah.
I
impressed.
It's
know.
That
Look
is
at them.
amazing.
I
impressive that
mean,
Yeah.
you
isn't that amazing?
It
Like, this is
totally.
in,
so
I
amazing.
in
Yep.
high
it
school.
in
Yeah.
high school,
Wow.
when you guys said you were in high school, like I don't know what I mean, even college would be amazing to do this. And
Yeah.
yet in high school.
Oh, yeah.
So yeah, I think we're all like just blown away on that. So just great
I want
job.
to know what colleges you're going to.
What?
What colleges are you going to?
Not sure yet. I'm a
Oh,
junior and she's a sophomore, so we apply when
Yeah.
we're seniors.
Oh.
yeah. Okay.
Do you know
Well,
what you want to study?
Yeah, I think both of us want to do business, but I want to go into marketing.
Mm.
Awesome.
That's
mm,
awesome.
yeah,
Thank you again, guys. Thank you so much for
yeah.
having us
You.
and this amazing meeting. We appreciate it.
Yeah, and we'd
Yeah.
like to thank all of you. We know how busy you are, and it means a lot that you chose to spend part of your day with us, especially Joel. He took time out of his evening to give us this really insightful presentation. And we'll be posting his website and his contact information, as well as a short recap of today's session on our website. And you'll also receive a quick follow-up email with a survey and a link to the recap in case you want to revisit any of the topics.
Okay, great.
Okay, thank you.
Excellent.
Thank you for
Thank
having
you.
me.